Alright, let's start this video with one question. When is the best time to invest? The answer to this age-old investing question is deceptively simple when prices are low. However, trying to time the market, so waiting for the best time to buy or sell an investment, is extremely difficult. When I was younger, I thought that timing the market would be beneficial. But I was wrong. Fortunately, there is a strategy that can help you buy more when prices are lower and help smooth out your purchase price. Hi, Jarod here, and today let's talk about, well, nothing. And let me explain. But first, let's talk about the 4 tips that help me invest in the stock market, from long-term investing to the right way to get ready. And let's dive into it. Okay, first, what's the goal of an investor? Making money, right? Investing his hard-earned money, hoping to have more and make a profit in 2 years, 5 years, maybe 10 to 20 years. But there's a catch. Most of us as investors are irrational, and we tend to see this falling red market as bad and green as good, even with my portfolio when it's composed of diversified stock, so when some are going up, others are going down. Even if I know that is typical for a portfolio, I could still think that I'm bad as an investor, that I invest in the worst moment. And this is called timing the market, so it means trying to buy low and trying to sell high. However, this is incorrect. No one can predict the stock market, and here are 3 reasons. So, no one has a crystal ball. Stock prices are unpredictable. We do not know what is going to happen. Maybe Apple's stock price will go significantly up the next year because people think the stock is worth 10 times its current earnings. Right. Or maybe the stock will go down significantly simply because people don't like Apple anymore, or they might simply need their invested capital to buy a new house, car, or other stocks that they think will be going up. Okay, so secondly, it's an emotional roller coaster. So when it comes to investments, company stock prices and markets are fluctuating wildly on a daily basis. A market timer may be tempted to sell the investment too quickly to capture a small profit or to avoid a loss. For instance, let's take a look at the S&P 500, so the basket of the 500 biggest US companies. As you can see, since 1982, it went up and down. It lost 45% of its value from 2000 to 2002, like the terrorist attack. It lost 55% of its value from 2007 to 2009, like the housing market crash. And finally, it lost 30% of its value in 2020 because of the pandemic. And on the other hand, the index always recovered after those massive drops. And by the way, the S&P 500 has returned an average of 10% a year since the beginning, no matter what the economy or investors were doing. So, timing the market is something to avoid, whereas time in the market is something you wanna keep as a habit forever. Okay, so now that we know that time in the market is one of the most important components of investing, the question would be how to invest wisely. And I personally use a technique which became highly popular, known as dollar cost averaging. Dollar cost averaging is the practice of investing a fixed dollar amount on a regular basis, regardless of the share price. And it's a good way to develop a disciplined investing habit, be more efficient in how you invest, and potentially lower your stress level, as well as your cost. And why it doesn't promise a profit or to protect you against a market downturn, it helps you to reduce the risk of investing at a single point in time. Okay, so let me explain. This is Apple from the beginning of 2022 to right now. As always, it went up and down. So, 2 possibilities. First, you invested $1,000 right at the beginning, almost a year ago, which would have bought you almost 5.5 shares of Apple. In the end, you would have $870. Let's keep that in mind for a minute. It also means that your $1,000 invested would not be in your wallet anymore, so in case of an emergency, you might need to sell at a loss. But instead of investing all of your money at the same time, you decide to invest monthly a few $100s. In other words, dollar cost averaging. So let's say from January 2022 to November 2022, you invested those $1,000 spread out each month, so $99 each month. And at the end of the year, you would have earned $1,061. And in fact, you would have many profits. You would have 22% more with the technique dollar cost averaging. As you can see, those two investing techniques are useful, but each one is for different investors. The dollar cost averaging technique is safer. It helps smooth out your purchase price in a long period of time, while allowing you to keep a huge chunk in cash at any moment. And on the other hand, investing 100% of your capital at once means you should think in the long term, so between 5 to 10 years at least, while knowing that you will encounter downturns, maybe recessions along the way. Okay, now this is an important thing to know. People can make this mistake, especially when they start in the world of investing, and I myself was doing it. I was thinking that the price you buy of, let's say, Microsoft reflected its real value. So if the price was going up, then it meant that Microsoft was a better company, like more customers, better products, more sales, so increasing net income. Or the opposite, if the stock price was going down, it meant that Microsoft was a bad company, with decreasing sales, bad money management, and thus decreasing net income. And well, I was extremely wrong, because even if the price goes down, then the value should still be steadily growing for a long period of time. And to give you a better idea, here are the numbers related to Microsoft. You can clearly see that it has an increasing net income over the last 5 years, so around 32% a year on average. The company has been paying dividends continuously for more than 17 years now, with a current dividend yield of roughly 1.15%. And moreover, it has a good increasing return on capital of 22%. So those numbers are only a green light for a company like Microsoft. It shows that the company is already a big ship that is hard to move. And here's Microsoft's price over the last 5 years. And since the beginning of this year, it went significantly down, right? Losing 30% of its value. As you can see, while the company is still highly profitable, its price is plummeting. But did the company sell 30% less products and services than last year? Nope, they did not. And this is simply due to random investors selling their shares for so many different reasons. Because everyone is doing so, they get scared, they need their invested capital, and so on. And with some research, we know that Microsoft has a huge advantage compared to its competitors, like Windows, cloud services, devices, and also gaming. And on top of that, the company has made some interesting acquisitions, like Activision Blizzard in 2022. And to give you a broader view of the market, here is the S&P 500. So again, the performance of the 500 biggest US companies. And the index lost 25% of its value. But did the companies sell 25 less products and services than last year? Again, nope, they did not. Alright, when you see a sudden change in the stock market, you might feel tempted to rush into buying or selling the stocks, either to ride a wave of growth or minimize losses. However, instinctive reactions don't always make for sound financial decisions, and by acting too quickly, you're more likely to make those costly mistakes like selling low. However, instinctive reactions don't always make for sound financial decisions, and by acting too quickly, you're more likely to make costly mistakes like selling low or buying too high. And it's important to keep a cool head when the market is volatile and avoid being distracted by your emotion. Alright, so have you ever seen this graph before? Probably, but even if you don't, I'm sure we all experienced it somehow in our life, whether it is investing in the stock market or even our daily life. So this represents the market in a simple way. Most people will be pleased with their investments in the beginning and will buy even more when it's in euphoric state. And once the market will point its nose down, then people will probably be saying that it's a temporary downturn, right? But once the market is stalling, like it is sometimes doing, people will want to sell. Okay, in fact, I've learned to remove this emotional and irrational thinking. I remember in the beginning checking my portfolio every day, wondering if it went up or down and why, and hoping it would always go up. Well, I was again wrong and I've stopped making this mistake. Now I check my accounts like once a month, maybe twice. But that's it. Okay then, Warren Buffett once said that it is wise for investors to be fearful when others are greedy, and greedy when others are fearful. And his quote relates to the price of a company. It's all about emotions. Remember when we talked about Microsoft earlier? Well, when others are fearful, it may represent a good value investment opportunity. And this idea comes from understanding market psychology, because often emotions such as fear and greed drive investors. Greed may keep consumers buying and buying up prices in the hope of ever increasing returns or profits while markets are rising. And this, in turn, can lead to asset bubbles that finally burst. Being ready when others are fearful does not take an extraordinary effort. You simply have to see the market crash for what it is, an opportunity. Search for good businesses with good long-lasting dividends, net income, return on capital over the past 5 to 10 years. Also, make sure it has bigger advantages compared to its competitors, like Apple with the iPhone in the US. And above all, make sure that you love the company you invest in. This will allow you to hold your positions even during bear markets or when markets are down. So, what do you think about my tips for investing in the stock market? Would you have anything else to recommend? I'll be highly interested to know your point of view. Thank you so much for watching. Feel free to leave a comment down below, subscribe if you want to see more, and as always, I will see you in the next one.